Oh, hello, everybody. Thank you for joining us today. And more people are going to trickle in. So to the 9 of you who are already online, well done. You are totally on time. Now, it's Serena Gibbon here from the Auckland Property Investors Association. Thank you for joining us at our May keynote meeting. I have with me Chris Peterson from Chris Peterson Mortgages and Insurance, as well as Nick Gentle from I Find Property. And you'll be hearing from the two gentlemen very soon. Now, to start off our web session, as always, just want to make sure that the tech's working. So now, in the chat box to the right-hand side of your screen, if you can hear me and see the holding slide, I've got logos of all of our lovely sponsors on the page. So you should be seeing all of our sponsors' logos, as well as Nick, Chris, and myself at the bottom right corner. And if you can hear me as well, I would love to know in the chat box what you are going to be doing on Thursday at level 2. So if you're going to go to your local McDonald's or go get a coffee or whatever, I would very much like to know what everyone's going to do. So please leave me a comment in the chat box. I don't personally have a lot of plans myself. I'm actually going to be doing more gardening. So not quite sure how level 2 is going to change that for me. Oh, Peter's off to the rubbish tip. I feel like I know which Peter that is. Not much has changed for you, Peter, which is comforting. Nice, Nick. I'm pleased to see that Nick is going to be tuning in on Thursday to our chat with Debbie Roberts about what our capital gains investors going to be doing and how you're going to make sense of the 2020 property market. But yeah, no, great. Everything seems to be working. So let's get started. Loads of good content today. So as always, to start off the evening, I just want to acknowledge all of the sponsors and all the APIA members out there for supporting our little organization. We're a really small team, but we're just super energized and excited that we're able to touch point with you guys so regularly throughout the lockdown, and that by and large, everyone is feeling positive about the coming few months and the opportunities. Oh, Jason, good luck with the 5-year-old's haircut. Fingers crossed. Happy birthday to your son. Now, let's get going. So today's main topic, as always, COVID-19, and both Chris and Nick are going to give their perspectives on sort of within their respective fields. More on that later. Short disclaimer statement. Basically, everything that's going to be covered today is general information only. Nothing is intended as legal, financial, or tax advice. And, when appropriate, definitely seek a professional advice. If you're wanting recommendations from us, feel free to email our office. I'm going to pop our email in the chat box for those of you who are interested. Now, I'm just going to do a bunch of housekeeping. I've split them up into 2 parts. So the first part is really just for your information. So June keynote meeting coming up Tuesday, 9th of June. So as always, second Tuesday of the month is when APIA does our keynote meetings. We have scheduled Jared Kerr, who is the Kiwi Bank chief economist, who's going to talk about, by June, the effect of COVID on the economy, the housing market, and how banks are, making their lending decisions, the property finance market. Now, usually in June as well, we have our annual general meeting. Now, that is very likely going to be delayed. So more on that in the coming announcements by email. So please keep an eye out for that. And now, I've been asked quite a lot as well, because today marks the 48th, this particular session is the 48th digital session we've hosted since since the start of the lockdown. And by the end of the lockdown, we would have done 50. So first of all, thank you to everybody who's engaged with us, who's came on, turned the camera on and spoke to us and asked questions and dialogued. It's just been a really meaningful time for the association. I think everyone's feeling very connected with the community. So that's super awesome. Now, I've been asked a lot by people whether we will be continuing with the unscripted sessions, so the Google Hangout sessions, and also the legal, financial, and development clinics, the drop-in digital clinics where you dial in and ask questions from industry experts and dial off. Yes, we are going to be doing those, not to the regularity of a weekly session. And also we're trying to work with our partners to find out more kind of work-friendly times, expecting that from level 2 onwards, people are probably going to start returning to work and not going to be quite as available online as we would like. So please keep an eye out on the events page for the upcoming session, but definitely it's been a very positive experience for us. So we're going to keep those sessions going. One thing I do want to remind people that with level 2 or even level 3, just remember that Schedule 5 of the COVID-19 Response Urgent Management Measures Legislation Bill, long name, basically the bill that says you cannot apply for termination unless your tenant is over 60 days in arrears, you cannot increase rent, and then a particular section on antisocial behavior. So all that temporary change in the RTA, that is still in force. So that got royal assent on the 25th of March. The initial period of application is 3 months, with the potential of certain sections being extended by a further 3 months as and when it's deemed appropriate. So please don't assume that because we've dropped to level 3 or to level 2 on Thursday that bill is no longer active. It is still in effect, and it's not at all pegged to the COVID-19 alert levels. So just be really careful with that. And Schedule 5 as well is quite a quick read. So I definitely would encourage you guys to hop on over to the website and have a look. Now, all the links I'm mentioning today, and also Nick's presentation as well, all of that will be linked in the show notes, which was sent out at 7:15 to everybody, and it will also be sent out once again at 7:30 p.m. tomorrow. So if you missed the initial email, don't worry, just wait till tomorrow evening. You'll be sent them again and you'll see all the links on there. So don't worry too much about asking for the links. Now there's quite a lot of pressure on the government to extend the Healthy Home Standards deadline. No update on that. Obviously, all the interested parties, including the New Zealand Property Investors Federation, to which APIA is one of them. Obviously, we're all pushing hard for it in the background, but no update as of now. And so carry on business as usual. If there's anything material, we will let you guys know by email. Now, housekeeping things for you guys to do, or at least I would very much like you guys to do. If you haven't already signed Peter Lewis's petition to delay ring fencing by at least a year, please do so by this Friday. That's when the petition closes. It's been incredibly surprising to me that out of a whole country full of investors, less than 2,000 investors are worried enough about their cash flow to take the time to sign the petition. And literally it takes less than a minute to do. So please do it. Please share it with your network and get them to do it as well. Now, at the time of putting these slides together, Tenancy Services hasn't released any guidances for level 2 for landlords and tenants. So based on that, I'm suggesting everyone hop on over to Ryan's blog to read its proposed guidance for level 2. It's a proposed stage at the moment, and obviously it's geared more towards real estate agents as well as professional property managers. But as landlords, the level of details and the guidance on there, I think it's really common sense and give a good balance between being, acting with an abundance of caution, but actually with business expedience as well. So if you're wanting to sort of know how to conduct your business operation during level 2, I would point you to Ryan's until tenancy services comes up with its own guidelines. I also want to remind everybody, this is a really strange economy we're all in at the moment. So with level 2, obviously there's going to be a bit of a boost to the economy. People are going to start spending a bit more. Please remember that loads of APIA members are also business owners. And if you are able to, we would love for you to go onto our directory page, which will be linked in the show notes, that has all of our members' businesses on there. And if you can support each other, I think it will be super awesome. Now, speaking of supporting each other, our longtime members, Rahul and Alika Rai, had recently set up, you probably had heard this on the news, they've recently set up a super awesome initiative called the Thank You Healthcare Initiative. Basically, it's a website that corrals Kiwi businesses that are prepared to offer our frontline healthcare professionals with really good value discount for your goods and services. So look, I think it's like a bit of a two-way thing. It's a way to say thank you to our healthcare workers, but also it's a way to give businesses a bit of visibility in what I mentioned before, a really strange economic time. So, I mean, APIA is listed on there. Please hop on over to the Thank You Healthcare. I think it's thankyouhealthcare.co.nz. You can see all the businesses listed on there. If you're in the healthcare service, take advantage of all the offerings. If you're a business owner and you'd like to be part of the initiative, please email Rahul and Alika, and they would very much like to hear from you guys. A reminder from the New Zealand Property Investors Federation that the Resine Refresh My Rental competition is ending this Friday. So to enter, I think you have to like write a little paragraph to Resine about why you why you can make use of $1,000 paint voucher, that sort of stuff, and send some photos for your rental, and you're going to a draw to win some prizes. So, you know, why not? And finally, it's a strange time. I keep saying that. And I'm seeing a lot of activity on the private Facebook page for APIA members. It's really been really good to see people asking each other questions, sharing ideas and photos, that sort of stuff. Please keep that going. You know, the more you engage with each other, the more content you generate, and the better we all learn as an entire community. So just want to use this opportunity to remind you, even though we are from next week onwards going to be sort of dialing back a little bit with our online sessions, because Pat and I are not machines, and doing 50 sessions in 6 weeks been quite a lot, and it's not a sustainable way to run the business. So, you know, if you're able to share some thoughts, ask your questions on our Facebook page. I think that's, to leave everyone, to sort of wrap up my intro before we go over to Chris, I just want to leave this quote online for you guys to all read very quickly. So this is, I grabbed this out of Tony Alexander's most recent newsletter when he presented his survey results of the real estate industry. And it's just a quick reminder that, you know, we're hearing a lot of really negative stuff in the media about the recession, the housing market, so on and so forth. And it can sort of, you know, mess with your mind a little bit, and just being mindful that in the time of a recession, the vast majority of people are actually not affected. And it's really just making sure that even though there are all these external stresses around and all these negative messages around, that you are still making sensible decisions and talking to the people you should be talking to, and surrounding yourself in the sort of right positive energy, which I'm sure Nick and Chris will also be talking about today. So that's it from me. Now, I'm going to turn my slides off, and we're going to get Chris to jump in. So Chris is from the APIA. Chris is the APIA principal sponsor through Chris Peterson Mortgages and Insurance. And he is here to talk to us a bit about how COVID has affected the financing market so far, and in particular, how the recent removal of LVR and how that's, you know, what he's seeing in the financing market as a result of that. If you have any questions, use the chat box for Chris as well. Thanks.
Thank you, Serena. Hope everyone's well. Can someone just confirm they can hear me okay? Just in the chat box. Fantastic. Okay, so I think that quote that Serena mentioned ties in quite well to the main thing I'll be talking about tonight, which is the LVR changes, because that's definitely already spurring investor interest. I mentioned to one of my staff, I think around the start of last week, that if we weren't keeping an eye on the media, we think we're in boom times, because the inquiry level's gone a little bit manic. So I suppose to have a bit of a chat about the loan to value restrictions, I want to talk about how we got here. And back in 2013, the Reserve Bank initially implemented the restrictions for the first time. That primarily hit the first home buyer market, restricted their ability to get in. Over the following years, there were various changes. We saw in 2015 regional restrictions around Auckland, which was the first time the investment market took a bit of a hit, followed by the following year where 40% deposit restrictions were put in nationwide. And since then, we've seen a bit of relaxing, with investment LVRs, of course, go back to 70, and more room in the higher LVR owner-occupied space in regards to what the banks have been allowed to do. So 3 weeks ago today, the RB, the Reserve Bank, actually announced a proposal to remove all the restrictions, and they have proceeded to do so. Couple of key comments in regards to their release. I just want to focus on those quickly. This decision was made to ensure LVR restrictions didn't have an undue impact on borrowers or lenders as part of the mortgage deferral scheme implemented in response to the COVID-19 pandemic. And this has caused a bit of confusion behind the scenes, because firstly, part of the reason they did it was there's a lot of investors or first home buyers who might be right up on those LVR limits. And of course, if they took a deferral, it could suddenly put them over. And the Reserve Bank wanted to make sure that banks weren't restricting people from some of these measures to kind of give people some release from the pressure that's going on at the moment. So that is one of the reasons why they have removed the rules. So we are obviously focusing on, is that one of the big reasons? We're thinking there's still going to be other room to move with them as well. Another key comment was the Reserve Bank has decided to remove, or has today decided to remove mortgage loan to value ratio restrictions for 12 months. And that's really important. So these things haven't been signaled as to be removed completely. They basically say they're coming off now, but there's a very good chance in 12 months they're going to review. If the banks start doing a lot of investing activity over the next 12 months, there's a very strong chance we've only got a small window to get in there and actually use these lower deposit requirements to kind of, shall we say, make some money and kind of pick some more properties up. So on the back of that, a couple of things as well. There's a chance the banks may decide to get restrictive early, because if we look what a bank does with a pre-approval, is they put out, an option where someone can decide to go to market and pick a property up for, say, a 2 or 3 months window, depending on how long the pre-approval lasts. Banks are going to be wary of doing heaps of investment pre-approvals, probably leading into May, because suddenly if the bank puts a restriction back in, the banks could be breaking their banking covenants. And this actually happened back in 2013, where we saw ASB in particular suddenly literally pulled a whole lot of pre-approvals off the market. So there is a chance kind of going into around that March, April time last year, while the Reserve Bank has not put the restrictions back in, we may potentially see the bank start to tighten if they feel there's a good chance Reserve Bank may re-implement the rules. I don't think they'll do it 12 months to the day. It happens to be that in May and November each year, there's what's known as a financial stability report. The next one is 2 weeks this Thursday, and that is the normal vehicle that they do use to change the LVR rules around. I think because of how much is going on at the moment, they decided not to wait the extra few weeks, and they decided in regards to putting some confidence into the market, they were best to announce that early. I do think in regards to putting it back in, I'll be keeping a big eye on the review in May next year, because I think that's a good chance where they may re-implement if they decide that's the right thing to do. So what have we heard at the coalface since they've been pulled off? Kiwibank's actually the only bank who's come out with formal criteria. They've basically said existing main bank clients can top up their personal home to 90% as long as they meet criteria. They've got no appetite in the above 90% space, except for the kind of crown connected first home loan product. Investment, they have confirmed they will look at standalone investment lending up to 80%, not above 80, but they will look at it, up to 80%. If you do have your personal home and investment property with Kiwibank, they're going to limit that to 80 across the board. Now, note their policy does state that certain securities such as bare land and apartments may, I know I've just had a comment come through saying the screen has frozen. Serena, I don't know if you're on.
Yes, I'm on. Everything's working well at my end. So guys, if you're having some kind of screen freeze situation, I would suggest you refresh. Also, make sure that you're using this on Google Chrome as well, because we find that best. Oh, it seems like it's working now.
Fantastic. So hopefully I didn't lose many people. But obviously just in the middle of having a bit of a chat about Kiwibank criteria. So just to quickly reiterate that, so Kiwibank, same existing Kiwibank clients, they can go to 90% on owner occupiers. Investment standalone lending, they can go to 80. If it's combined, owner occupied and investment, they're going to limit across the board to 80%. So as I mentioned, Kiwibank's actually the only lender who's come out and really released formal communication. But as of a couple of hours ago, a staff member forwarded a ANZ email to me. So it's not a formal release from ANZ, and it was in regards to a particular client Ryan's working on at the moment. And the email included saying that 80% LVR on investment properties may be considered in situations where the owner-occupied property is also with ANZ. Since the other properties the client owns are with other banks, we may not be inclined to consider an 80% LVR. If you do choose to go down this route, my pre-approval we will be defunct and credit may have to sign off on this. So there does seem to still be a bit of stuff going on behind the scenes. Just my personal opinion that I wouldn't be surprised if some of the banks have been waiting to see around the announcement for level 2, potentially also keeping an eye on the budget on Thursday to see what kind of new announcements are made from the government in regards to relief packages before they maybe kind of bring criteria changes out. So while we've had the RB, shall we say, remove the restrictions, we're very much waiting, with the exception of Kiwibank, from formal shall we say, policy from the main banks. I'll probably be keeping a good eye on that for next week. So some key points to focus on, again, on the LVR side of things. While that's been focused on, loan affordability, in my opinion, is still the big issue that has not been addressed. I've been saying for the last few years that I think with a lot of investors, the stringent bank affordability rules has actually been holding a lot more investors back than the loan to value rules, because effectively we've now got interest rates in the 2s, but we've got some banks who are using assessment or test rates in the 7s, which doesn't make sense. It's completely way out of whack at the moment. So we're actually working with a funder behind the scenes at the moment to try and assist more in this space. Not sure on timeframes, not sure if it will eventuate, but we're realising that the servicing or affordability is holding a lot of investors back at the moment. If you are looking to invest and equity is an issue, remember what I said, suppose, towards the start of this, that there are time restraints in place. I would be kind of saying that you obviously want to make sure that your purchases are meeting buying rules and you are being careful, but there is a very good chance that we're not going to have too long with lower deposit requirements. If you, for some reason, are not looking to invest but are wanting to maybe do so in the future, you should strongly be considering split banking. So if you've got, for example, a home and a rental property with the same bank, what you want to do is park 80% on the rental property, pull as much unutilized equity into your home with a different lender. If the LVR rules return, basically you'll park the investment property and that lender off to the side for the time being. You should hopefully end up with some what I call unutilized equity in your home, which you can tap into even if they bring the rules back, and then you can kind of get back out there and look at options. So quick other points outside of the LVRs. It's probably expected tomorrow that the RB will announce more what we call quantitative easing. I won't get too much in regards to the technicalities on that tonight, but this is expected to kind of really keep interest rates low and for longer as well. So keep an eye on that. It's something which we haven't really experienced in New Zealand before. Interesting to kind of watch the space. Work is being done behind the scenes in regards to negative interest rates. So note that we're not expecting to see negative borrowing rates, but we're potentially going to see a negative OCR. Westpac have come out and they're expecting that may can actually happen before the end of the year. So we've got most lenders at the moment with short-term interest rates in the high 2s. We've got long-term interest rates kind of now around the mid 3s. So this is a market which I can definitely say a few years ago I never thought I'd saw. So, money's very, very cheap at the moment, which is obviously great from an investment point of view. So those are my main points tonight. I think there's a couple of questions there, Serena, if anyone else wants to throw them through as well.
Yeah, thanks, Chris. I think we do have time for a couple of questions. So Simone is asking, has anyone relaxed their apartment lending criteria?
No, and I don't expect them to. And that's, I suppose, a general comment. There might be certain apartment areas they do, but I look at the new build market personally as an area where banks are going to be quite concerned. If we go back to the GFC, one of the concerns is that you've got a whole lot of people who have purchased apartments in particular off the plans. People's financial positions will have potentially, because of what's going on, dramatically changed by the time settlement comes up, and there could be quite large settlement defaults. We've also got the influence of things like Airbnb going on, and potentially, especially in the Auckland market, maybe pulling rents down. So, I expect the banks to be quite concerned about the apartment market in particular, with there being quite a large amount of new apartments in particular coming on. So I wouldn't be surprised in some cases if banks maybe go back to 80% on apartments, 80% on investment properties, but still have some restrictions on the apartment market.
A question from Debbie. Quick yes or no. Is anyone offering anything below 2.99 right now?
TSB is doing 2.89. We've had some other banks for particular clients go underneath that, case by case scenario.
I think now is a good time to leave your phone number or Ryan's number in the chat box for anybody who needs to talk to you about financing afterwards. As you are typing this, Lindy, hi Lindy and Ewan. I haven't seen you guys in so long. Lindy and Ewan's asking, are you aware of any problems with valuers not willing to provide true valuations?
I have not seen that. What I think they're doing is they're talking more about market risk. So most valuers will normally comment on the market. We just bought a new house 2 or 3 weeks ago because the type of property had to get its valuation part of that. And, the valuers pretty much said, this is our opinion. We're doing standard valuation process, which is comparable sales. We don't have a clue what's coming out the other side of this, though. So they'll talk about the market risk and how that could have influenced the actual number.
Okay. And Mary, I definitely recommend you reach out to Chris and Ryan after the session because that sounds like a very personal question. But Chris, if you have to speak in very, very general terms, refixing, how long?
The question, how long should we refix loans? Well, the general commentary out there is fixed short because it's the cheapest rate. And going back to things like the QE, quantitative easing, and the general, expectation out there is that we're going to have rates low, and we're going to have them low for a long time. So for most people and most commentators, they're saying take the short-term cheap money for quite a while, but it does become a personal situation.
Okay, final 2 questions, not taking any more. If you have more finance questions, Chris and Ryan are running a regular finance clinic next Tuesday at 6 p.m. Details will be listed. Graham is asking, lending market, what's it like for industrial properties?
Commercial, I think there's a huge amount of the funding market at the moment. We've got a bit of a wait and see because the banks, in regards to what we come out into, you can talk to 100 people and have 100 different opinions. The general impression is the commercial market's going to take a pretty good hit, but I think that could be more connected to things like the office space market and things like that. I can't comment too much on that at the moment.
Okay, explain a bit more details, the reasons behind splitting your home from your investment property mortgages between lenders.
I'll quickly make 2 comments. Let's say you've got a owner-occupied property worth $1 million with 800,000 debt on it, and an investment property worth $1 million with 700K debt on it. At the moment, you've got no unutilized equity because you're capped out based on normal LVR rules. With the investment ability to go back to 80, move that to 80% here. So top it up to 80, pull the cash across, put it into the home with a different bank. That means you've got 100,000 of unutilized equity, which you could use for deposits, working capital, etc. If the rules come back in, well, this bank parked over here is pretty much going to be useless, and the property you're not going to do anything with. Suddenly you've got this equity you can tap back into for moving forward with further investment. So that's point one. Point two is, in the last couple of years in particular, banks have started to qualify people. That's a good one, Serena, my ebook. So banks have started to qualify people at discharge. So what I mean by that, they may have given you the money in a certain time where money is nice and relaxed. And now when you sell a property, if you've got a couple of properties hooked together, they'll be re-qualifying you under new criteria. And if you don't meet it, they can take all of the proceeds and apply it to residual debt. So we've seen investors basically go sell a property thinking they're walking out with a chunk of money. Suddenly the bank's taking it all, and they wouldn't have sold the property in the first place if they weren't getting their hands on the cash. So by splitting, you're giving another level of protection.
Cool. Thank you very much. Very happy with that. And to Paul and anybody who wants to learn a bit more about avoiding the one bank trap, Chris has an ebook, and I have posted the download link in the chat box. Chris, you're great. Thank you so much. Have a good day. Talk to you soon.
Bye.
Cool. Cheers. Oh, hi. So now to the main event. I have with me Nick Gentle from I Find Properties and the Rotorua PIA. And also Nick is one of the, the main man for the famous Facebook. What's the story there?
It's the head of the adult daycare center is probably.
Don't say. Don't belittle what it is.
I'm just an admin in the group. Yeah.
Yeah, no, but you're and look, we've got Nick to come in today to talk about his coping strategies for COVID-19, but also more broadly around on the one hand there's this incredible psychological pressure on all of us to make sense of this chaos, and every day we're hearing the recession is coming, but then at the same time there's also the sense of there are a lot of opportunities out there. So how do we sort of balance the two, act with an abundance of cautions, but without kind of stagnating our personal growth and financial growth as well? And just want to do all of that, balancing it out in a really sensible way. So when Nick and I were talking around presentations ideas, we sort of found ourselves very much sort of talking about herd mentality, mindset, having a strategy in place, looking short term versus long term, and all of that really sort of way more complicated than I'm capable of even thinking. So look, here's Nick. I'm going to put you on the main screen.
Okay.
Let me know when you want to pull the slide.
Yeah, we can put the slides up.
Okay.
Otherwise, I'm way too big on the screen. We should.
Oh, is this
sounds coming through all right, everyone? I think the drill is for someone to pop a message in the chat.
It's sounding good to me. If people can't hear, if they can't hear, they're just going to leave a message to say they can't hear. So let's just assume they can.
Okay. All right. So thank you for that introduction. Okay, someone can hear me. Cool. So it's a pleasure to be invited. I was really hoping to be able to come up and do this in person. I've done about 4 or 5 presentations at different associations in the last 12 months, including being invited to speak at the national conference. It's been a really good experience for me. And I think my plan was to come up and talk about just my own journey as an investor. And I had this PowerPoint ready and all these jokes rehearsed. And then this, COVID broke out. So the message tonight's going to be a bit different. I'm going to talk just the introduction of me because I'm not up in Auckland a lot. Many of you probably won't know who I am and why I'm here. And then I'll talk a little bit from my experience about dealing with crisis and disruptions as a property investor. And then I thought one of the topics Serena and I thought would be interesting was, optimism versus pessimism. And one of the things I do is I'm one of the original two admins of the very large Facebook property investors chat group. The other guy is Graham Fowler. And so we're sort of front and center with 33,000 investors daily, with lots of messages coming forward and seeing what people are saying and thinking. And it's fascinating. And I also run an agency, buyer's agency. We have a database of more than 8,000 people. So, a lot of, I get to hear from a lot of folks through good times and bad. So I thought I'd talk a little bit about that, because over the years I've seen different people get different results in the same market. And so it's always interesting to try and figure out why. I'll talk a little bit about differences versus the GFC and the Depression, because obviously you're seeing a lot of comparisons right now in the media. And again, ideas like herd mentality and counter-cyclical thinking as an investor. And we should have time for questions. Feel free to throw them up in the chat there, and if I can pause and get onto them, I will. Otherwise, we'll come back and do them at the end. So who am I? So my name's Nick. I'm from Te Puke. I grew up here in the Bay of Plenty. I'm actually at my parents' house where I grew up, because the lovely lady in the photo next to me is my wife of 12 years, and she's back in Japan right now trying to salvage her business. She runs a singing school, which, as you can imagine, in this particular pandemic, 30 people in a room singing was sort of got shut down pretty quick. So she's been up there moving it online and setting up live streaming and stuff. So for lockdown, on the day of, I threw a handful of t-shirts and a suitcase, grabbed my son, and we moved over to Te Puke to bunker down here, which has been great. Doing lockdown with two retired school teachers has certainly made it a lot easier. Although I did grab a handful of t-shirts. I literally had 4 t-shirts for me and 3 for my son for the 5 weeks or whatever it was of lockdown. I've been investing since 2008. I started because I was working in finance and I hated my job. I read Rich Dad Poor Dad and I thought a bit of freedom would be good. Very quickly built up some passive income. I quit my job at 31, probably a few years too early, but I don't know. It seems to have worked out. But like everyone, I think if you could go back and say, hey, do something a little bit different, it would be good. But that's probably a story for the next time when I get to talk about my own experiences. I'm a buy and hold investor. I have a portfolio. I think my passive income's about 150 odd. By the time all my interest rates drop, because unlike smart investors like Chris Peterson, I went long a few years ago, it'll be closer to 200,000 by the end of the year. So I'm looking forward to that. I do a lot of trades. I've done a lot of joint ventures. I do a lot of joint ventures still. So I'm an active investor, let's say it that. I co-own iPhone Property, which is a buyer's agency. I'll introduce that on the next slide. I'm the admin of the Property Investors Chat Group on Facebook, which 33,000 Kiwis are on now. It's a really fantastic resource, and it's grown very, very fast, and it continues to grow fast. And I lived in Japan for 15 years, so I think a lot of my investment philosophy has been shaped by the fact that I've been on the other side of the world. And so I'm very team focused around doing stuff. I've learned through this was the only way I could do stuff, that having a good property manager was essential. Builders, valuers, tradies, architects, designers, everything just made all the difference in the world for me. And it was really, broker in particular was the key for any success I've been blessed to have. So iPhone Property are a buyer's agent. I think we're probably the only nationwide buyers focused real estate agency, or an investment buyers agency. There are other investment businesses, but they predominantly sell new builds. We sell both. And our main service is you work one-on-one with an investor, someone like me, in the market who's sort of a pro and experienced in the market they're looking to buy in, set some goals, and they go out, work and find a deal. And a lot of our clients will be in Auckland say they want a property in Rotorua, or they want a property in Wellington, or they're in Wellington, they want a property in Auckland or overseas, and buying back here, overseas Kiwis. And so that's been a really popular service. And we cover the whole country. So in 11 markets, Whangarei right down to Dunedin. And our team are really, really experienced. Some of them are a lot more experienced than me. And it's just been, again, a real privilege as an investor, and just how fortunate I am every time I go out, I want to buy a property, I can just call someone on my team and say, hey, look, I want to add this cash flow, add this equity, or add this kind of deal. And a couple of weeks later, I get an email. So it's pretty good. And I do have a free resource, which anyone here is welcome to tap into. My website, the last line there, iphoneproperty.co.nz/course. It's free. It comes over a month, and it's about a dozen lessons, from goal setting to how investment works, etc. And that's a cool thing if you've got any friends who are bugging you about how to do investment, and after you've helped your 17th friend explain all this stuff, you get a bit tired, just give them that link. I'll sort them out. But let's talk about the crisis. And I got to tell you that today at about 6:30, I saw the link on the front page of the Herald of a butcher in Auckland who's taken his own life because his business failed during COVID-19. And that probably hit me a lot harder than anything else has in the last 6 weeks. And I think we're getting into through the silly, what is it? When lockdown was started, it all felt like this kind of surreal experience for us in New Zealand, and you know, through this, and parents with kids at home telling jokes, etc. And obviously we're looking at this news overseas, and it's far away. But now we're getting to the point where the brutal financial reality of certain businesses is starting to hit, and it's going to be a real challenge, I think, mentally, to be an investor in let alone a business owner, through this. And as part of being on Facebook, I see, just obviously there's a ton of opinions and questions and stuff coming through this. And I think the way I try to think about this, and when I do coach people, and this is not just in managing crisis, this is how do I become a good, successful investor, is the biggest sort of hack or trick you can do is to think of it as your job. So if you imagine that you've been hired by me or someone else to grow some wealth. So you get some resources, a deposit or equity or something, and your job is to go and improve it. And you've been employed, and it's your day job. And you're going to get paid based on your success. And if it doesn't work out, then you don't get to come back to work. I mean, that's the condition of you succeed, or you're done. And I think that kind of like, I need to be a professional idea changes the way you act, and the way you handle bad things happening, and the way you prepare and go out and get information, and what you try to DIY and what you outsource to others. And that's everything. So people who go to the bank directly to try and shave a millionth of a % off their rates, no professional investor does that. People who, there's just things like that. And crisis management and planning for bad things is equal part of this. And I'm sorry, but if you're buying an investment property, planning for downtimes is part of your job description as being a custodian of my wealth, or whoever's taken you on, or you've taken you on. And this is my favorite graph for investment ever, because when you get into property investment, and when you see people get up there and they do these seminars and they say, look, I started out here, and 10 years passed, and I had all this growth, and I'm wealthy now. You think, wow, that's it. And it can look a bit easy. But when you get into it, success and long-term is nothing like that. And we're right now in the middle of one of these squiggles, and the mess of what, a bad thing can happen. So the best advice, and if you take anything away from this presentation, is to prepare and treat it just like it's your work. So something has happened, it's not good, and now you need to adjust your business to get through it. And that is a really good way to take a lot of the emotion out of it, and also to stop reacting individually to news stories and what people say on Facebook and etc., and just focus on it being a business and kicking on. So the first thing that I think is important when we're dealing with this is to work out dealing with the crash. And when you're dealing with the crash, you're dealing with the short, immediate term. And two things matter, I believe, right now, or at least for the last 6 weeks and probably for the next 90 days. Cash and cash flow. Cash and or access to cash. If you lost your job and your tenant stopped paying rent for a while, you're acutely aware of your need for cash. Likewise, for businesses or property owners, cash flow is critical. I haven't heard anyone talk to me saying, I want capital gains for the last 8 weeks. Everybody I'm talking to right now is now really, really focused and clear about cash flow, reliable cash flow, etc. So the mental model has shifted from speculation on growth to covering my bases, covering my cost, having buffer, etc. And the investors who had that from the start, I think, are a lot less stressed than those who suddenly thought about it critically for the first time when it became acutely obvious now. And I put something up on Facebook a while ago, and it's just an exercise on how I plan around cash flow. And it's the first thing I did when things started to get bad. Well, the second thing I did, I'll talk about the first thing I did in the next slide. And this sort of highlights where I think the risk is for investors. So this is a theoretical property, and I just pulled the numbers out of the air. So, and when I put this up on Facebook, someone started picking it apart and said, where are you going to get a property with those rates for that price? And just ignore all that. So look, here's the price, here's the rent. I hope my mouse shows up. The annual rent is here. Then you borrowed 100%. Here's the interest. This is 2 months ago, back in the old days when interest rates were really, really high. Annual interest rates are this. Here's some fixed costs, 1 week of vacancy, net income. That's on interest only, okay? And so I started modeling rent decreases and took down rent 10%, 10% rent drop. Now interest rates have also dropped, so 10% this drop here. And I doubled the vacancy period. Just wanted to see what a 10% rent decline would look like. $500 a year, okay? Some people are saying 20%. 20% decline, rent goes down to $360. Interest rates are still low. Looks like they're going lower. 2 weeks vacancy. Now you're at break even. And the point of this, and what this highlighted to me when I was just thinking, okay, what if rents go down 10%, 20%? Because if anyone who invested during the GFC will, like me, have had periods where rents were flat for ages and you had to drop for $20 for a while, and then you might have had a spell if you're in the regions of, no tenant, is nobody is going to go broke as a property owner over $2,500 becoming $2,000 or $2, zero a year. So the cash flow, the drop in interest rate is providing a massive buffer for cash flow. So the risk for us as investors is solely around cash. If something, if you go for a no rent period, so lockdown 6 weeks, no rent, the government announced these mortgage holidays, and every tenant in the country called their property manager and says, I'm not paying rent now because it was poorly communicated. And, a lot of folks have suddenly moved from their income not going down to 20%, might have gone down 100% for a while. And if you didn't have cash, you were panicking. Not many owners were worried about a 10%, 20% decline for a few weeks over lockdown. And the reason I think I wanted to make that difference is eventually this lockdown period is over now. Hopefully it stays over. And whatever rents do, they're going to stabilize. They're not going to drop to zero and stay at zero forever for your house. You'll get a tenant in at some level, and you'll get income in, and you'll get the low interest rates at some point, and you'll cruise on. And the cash is the piece that matters because it gets you to that next step. So a few things I did right at the start. So, and I do this whenever I try to do it regularly, but the first one is to keep my revolving credit lines as high as they can get. I can always not use it. If I buy a house, banks might say we need to cut your revolving credit. That's fine. All I was trying to do was set up access to extra cash. So one of the banks let me add $100,000. I think another one, another 100 in a bit. So by signing a few bits of paper, I basically got access to a couple of $100,000. That's still there. Haven't had to touch it. Might use it for trading or something in the future, but that just meant, my cash risk went from, I had a good buffer already, but it was, a lot better. I called my property manager straight away and basically confirmed how he planned to handle the tenants wanting rent reductions. I, like most owners, essentially approved it as long as the tenant had gone through the subsidy programs, etc. I took a trade, and this is probably something that only really people who do trades might relate to. Is a lot of trades are paid for just straight out of revolving credit, and I basically refinanced that to another lender. So I turned a bunch of cash into, I had a lump sum that had basically paid for this property, and some of it was revolving credit, some of it was just cash deposit, and I refinanced it and got 70% of that back in my bank account. So that freed up another $100,000 or $200,000 more cash. I don't have a lot of debt on P&I, but I certainly agree with a lot of the folks that said that, moving your loans to interest only is a big cash flow boost. So none of this, I'm not taking any deferrals. I think I know a lot of people who have more on with their own homes, is taking on a whole lot of extra risk, or, for me. But it definitely increased my resilience and meant that, if it had got messy, because, back in mid-March, it was getting pretty hairy there, I was feeling a lot, safer and more, in control, to the point where I thought, okay, well, I could go down to 50% rent. I've got about $3 million of debt. So I thought, if I go back to 50% rent or 30% rent or some terrible things, or the students all leave, I can ride it out for 6 months, worst case, because in a crash, you just don't want to be in a position where you're a forced seller. If you're a forced seller in a slump, that's when you get into real trouble. If you can ride it out, even if you get stuck, over time you're fine. Obviously, if you don't have to grind down, you can be aggressive and go out and invest, and that's even better, but you just don't want to be a forced seller. So all of this was around protection. Optimism and pessimism. So this is more into what I see in the Facebook group. And so I find property and property investment helping others for 6-7 years. And the fascinating thing is we're all in the same market, right? Auckland, other cities, same banks, same population. It's not the matrix, we're all in the same reality. And yet everyone gets different outcomes. Now, obviously, there's the different goals, life drivers, etc. But a huge, huge part of this is what goes on in our own heads. And I thought I'd talk a little bit about that, because that's going to impact how we see and shape and react to what's coming in the next year or two. And I agree with Chris that a lot of what's coming is we don't know. A lot of it's going to be pretty scary. We're going to see some pretty scary unemployment numbers, and mindset is going to be key. And as I was researching this, I found this slide, and I love this slide. This might be unlock the keys to not just investment success, but life success and professional and relationships, because it's a little bit confusing. But if you've got an optimist, and what it's saying is whenever an optimist has a good experience, what goes in their head is it's like me, I cause this is permanent, this is going to impact my whole life. And a pessimist, they have those reactions when they have a bad experience. And on the other side, when an optimist has a bad experience and they say, oh, this isn't me, this is just temporary, it'll pass, it's only a small part of my life, they can compartmentalize it. A pessimist actually takes that, and that's the reaction they have when they have a good experience. They dismiss good experiences and basically say, well, I don't deserve this. This is fake. They believe it's going to go away. And I thought this was a really, really cool way to represent that. And I think I'm an optimist. I believe I'm an optimist. I'm certainly not pessimist. And I don't think you can be an investor as a pessimist. It's very hard to build towards the future if you don't believe it's going to be much good. So I think as a default, anyone who starts a business or invests, unless you're, I don't know, hedging against the doomsday event, is an optimist. And that's why we're all such positive people at property. But there's a miss, and I see this next one is what I see all the time on Facebook when people start fighting with each other, and people are optimistic about the property market are accused of being risky and I guess lazy thinking and having something to sell or whatever. I mean, Tony Alexander he's quite optimistic around housing, and you see people pick his arguments apart on Facebook, and they say, no, this guy's risky, etc. And I don't think optimism equals risk. Two very, very different things. So I'm going to do a couple of slides around the differences, and I'm also going to do a slide on just what I think of as risk and an effective mental model to manage risk, so that it lets you become more optimistic because you've taken the risk and made it not this big, vague, fearful thing, and also and it's broken down, but you've also got it properly weighted as opposed to being, I guess, too flippant about it. So I think if you understand and manage your own risk, it's very easy to be optimistic. And I know this comes back to being the professional investor. The professional investor has critically thought about their risk and broken it down to numbers. Like the example was that cash flow thing. What if rents go down? Everyone's worried about what if rents go down. Rents go down, I think it was going to cost me about $30 or $40 a week. You know, what do you do? If you don't understand and manage your risk, this is where you get dangerous to be optimistic. So these are folks who, I often see people who think that they're not good or smart at numbers, and therefore are looking for someone else to give them the formula, and then they run with it, and they take that formula and take with their life. And in that case, you're sort of putting the trust in the other person's hands. So you really need to put the effort into understanding, managing your own risks, and then you can invest well. Someone who appears to be risky might just be better prepared than you. And anybody who's a trader or has done a big deal, or even if you're an investor and none of your friends and family are, and you talk about what you're doing and they say, oh, it's risky. No, I've just done something and I'm working through it and I have a plan and I've prepared. It's not necessarily risky. Bad things might happen. That doesn't mean that the activity was inherently, overly risky. There's a risk in anything. There's risk in doing nothing. There's a lot more risk in doing nothing than there is in doing something. I did a property deal where I completely gutted and remodeled 2 floors of an old villa in Wellington. I think by the time I'd done it, it was about $450,000 in renovation spend. It's huge. And that went over budget by about 60 grand because the foundation had issues. Every single investor I talked to that about 3, which just like looked at me with whites in their eyes. What are you crazy? But I thought I had a licensed builder, structural engineer, an architect, a property manager, a valuer, my broker, all crawl all over this thoroughly before I started. And then I pulled the trigger. So I thought my risk was well under control. And also, this last one is someone who appears dangerously optimistic. Actually, they might not be better prepared than you. So again, it comes back to you to really understand this. So this I'm stealing, this next concept from an investor friend. I'm not sure if he's watching tonight, Michael McKinven. I believe he's a member in Auckland. He's been in the Property Investor magazine recently. He's a successful investor and commercial investor. And he talked to me about this about 7 years ago, and I took it and ran with it. And it's, most people think of risks and this as things that can happen as separate events. So like my car might die, or I might lose my job, or interest rates might go up, or my tenants might damage the house. And I think a lot of when you're starting to study investment and people are learning for the first time and you're explaining different things, this is how obviously people take things in, because you're learning these concepts one at a time. And most people think they're perfectly safe in all scenarios because you go, okay, well, if my car might die, I've got $5,000, I can go and get a new car. And lose my job, then okay, I'll start to use my savings a bit to live, and then I'll go get a new job. You know, interest rates go up, you know, etc. And each one you work out what you're going to do. But what folks never do is they never stack them together. And it's like, you know, my car might die and I need 5,000, but I don't have a job. I've got property damage, which is misspelled, long vacancy, and my mum needs a hip replacement, and this and this. And I think if you and this ties back to being prepared so you can be optimistic and invest with confidence through a crisis, is if you stack up a few of these things that might happen and make sure you've got mitigations in place, buffers or what have you, contingencies, so that if 2 or 3 of these things happen at once, then it's a lot easier to be confident going out and doing making investments. I had a chat with a young guy about a month and a half ago. He called me, and I'd just spoken to him a few days ago. He called me and said he wanted to invest, and his job was in tourism, and he had young partner and 3 kids and a mortgage, and he wanted to start investing at a pre-improve. And I said, look, I don't know. Do you have any other way to support yourself through this? And if tourism jobs are going to be, they're at risk. And in the end, he didn't proceed. I actually said, look, I don't think now's the time for you, which is, I'm always wary of doing that because I'm not a financial advisor, but I just had a feeling that he hadn't quite thought of enough buffer in place, and he lost his job the next week. And he hadn't sort of figured out, if these things happen at the same time, what could happen. So my advice on this is getting to planning and having a handle on your life, so that when we do get into the thick of this, because the news is going to get a lot worse. There's going to be job losses and God forbid more mental health issues. Let's just leave it at that. Going through the next few months, it's going to be hard to be a confident investor out there. And a big part of your base is going to be having a handle on, okay, my own situation, I've got it under control. I've got mitigations in place to do this. I can go out and I can make this bet on whatever it is that you're planning on betting on with your property. Now let's look at past crisis. Now this quote, it's a famous quote, and it's always used in bull runs. So this is always used, obviously he's talking about when the market's gone up. And everyone thinks it's different. And I was chatting with a friend the other day, and he said for the last 3 years he's been trying to find out what could cause the market to crash, because immigration was strong, interest rates are low, global demand is strong, all of this stuff. And everyone's saying, oh no, it's different this time. And leading up to GFC, it's different this time. And of course something has happened, and here we are. And every crisis is a little bit different in what triggers it, but the financial implications of it are generally similar, and the sentiment of people is always the same. It doesn't matter how bad it gets, everyone thinks it's going to get a lot worse, and you'd be mad to do something. So that's an interesting thing to have in mind. Go back and read the newspaper articles in 2008 and 9 about the global economy and property, and then 1997, 8 and 87, 88. So I thought I'd talk a little bit about some differences between this and the GFC. I invested through the GFC. I was working in banking in Tokyo in the GFC. True story, I was playing a game of expat cricket with half of Lehman Brothers IT team, including their CIO when they went under. Got called that day. So, man, that was a surreal time as well. But there's a lot of differences, and a lot of the differences have come out of the learnings of what went well and what went wrong during the GFC. And it's a similar thing, again, doing comparisons with the Depression. The level of government and bank support is just massive. Matt Gilligan did a webinar, and I've seen a recording of it, and his phrase is they're throwing the sink at this. So globally, the governments, the banks, everyone is just trying to prop this up. The banks have learned not to come after you when times are tough. It's not good for long-term business. Now, I think I need to pause and say that I think business owners are going to have a harder time with banks and property owners in the next little bit. So my comments here are really around residential property investors, and I do know that from having chatted with a couple of friends who have retail businesses and they have, trading accounts with banks, that it is getting pretty tough. Dealing with the banks right now, the level of scrutiny that's already starting to be poured on them. The mortgage deferral program, and I'm not a broker or financial advisor, but I have a lot of friends who are not in the property investment space who have done this. And what it did was it let anyone who was went onto lockdown and had to go into reduced wages or whatever, not worry about their housing for a few months until either their jobs had started up again or they had time to go out and try and figure it out, 6 months. And I've seen all the analysis saying, look, it's a terrible thing. You're adding on all your principal and your interest, and you have to pay it back in a shorter time. But as my friend, the builder who did it, said, it adds $8 a week to his mortgage for the rest of the mortgage for the price of not having to stress on his house for the next 6 months, and he's got a wife and 3 kids. So that's what the mortgage deferral program has done. It's enabled a huge amount of peace of mind for people to go, and the wage subsidy, to go through this government, enforced lockdown. I think it's really, really good for mental health that they've done this. I don't know, obviously, the financial implications of it, that's still to come. But, you're not going to get people going along with 5-day extensions of level 1 and then 3 weeks of level 3 and all of 4, and then all this stuff if they can't pay their bank. The interest rates are super low. No jokes. I got in about 2 months about best part of $1 million dropping down from 5.09 to whatever it is then, and that alone means that my rents can drop a chunk, and it's fine. So like on that chart I did earlier, I think even if your rents go down, if you can just get yourself to the point where you start going onto these lower interest rates, even if you're a muppet like me who went long years ago and sort of didn't do any of the short stuff, it's going to definitely make this a lot easier. And the low interest rates also, I think, from a survivorship, going to the GFC, stuff was 9-10%. It was crazy high. Looking back, and obviously 10 years ago it was higher than before it was higher again. The 3%, if you got a house and you've paid off some of the mortgage and and you go into interest only and the interest rates are 3%, you can hold on for a lot longer than if the interest rates are 8%. And if you have to defer a mortgage, it's a lot more feasible if you're deferring it at 3% or 3.5% than if you're 6 or 10 or something like that. The bank system is really healthy this time around. I think the LVRs, and as Chris rightly pointed out, the serviceability test, which is the true handbrake of any investor. has really meant that not a lot of risky lending has been done. So, you know, if the banks have been assessing us at 7% for ages, and with 30% deposits, etc. So people are in a pretty good cash flow position on their rentals. They should be. Unless obviously how much of your personal income was being used to prop those up. But in general, the sensible lending has meant that we're way less exposed than we were last time. In the Great Depression, I'm just going to touch on this because I see responses saying like, oh, it's the worst since the Great Depression. And I think, of course, it's the most unemployment since the Great Depression, because the government just told 80% of the population or whatever it is that you can't go to work. So yes, everyone's got unemployment. But the entire nature of the response is different. If you go back and look at, there's a really good book that you can get online called Big Debt Crisis by a very famous investor called Ray Dalio. And he breaks down the key differences between the GFC and this. And I read this early in the piece, and it was quite reassuring. The depression, the economic theory going into depression was that when stuff got really bad, you should stop spending, pull back, restrict everything, basically go back to zero and then slowly build up again. And what happened was everything contracted and kept contracting. There was nothing to go again. And it wasn't until about 4 or 5 years into this thing, maybe even more, that the government just almost because they tried everything else, went on to a stimulus sort of bent, and things started to improve, which really led to modern economic theory. So the approach to this is completely different, and it's a health crisis first. So I mean, the tools are there from an economic front to get the world through this. I believe it's more on the health and that sort of policy that I think things are riding on, which is actually probably the biggest concern of this, because it's a virus. It's different from some people in the country borrowing too much and having to go away and lick their wounds and get ready to go again. And the last topic I want to go into is a bit on counter-cyclical thinking, because it's an interesting one. I'm sure everyone's heard this famous quote by Warren Buffett, which is be fearful when others are greedy, and greedy when others are fearful. And the idea is that when the bubble starts to get pretty big, that you think, actually, this is when I need to pull back, when everyone's euphoric about markets. And now, and in these times when everyone's terrified and thinking how could it possibly ever get better, that's when you can go out and actually do well. And it looks a little bit like this hero stuntman, someone when everything's just a burning dumpster, and you just charge through and do this amazing daredevil like feat. And look at me, I went out, and despite that thing, I went out and I bought that property, and Captain America type. I know it's particularly 5 years from now, when people are looking back on who did this, I think some of the folks will get lionized in hindsight. But the thing about this counter-cyclical investing idea is that it's a really sexy idea that's very hard to do. And it's possibly even harder to do now with the amount of information and, let's call it, online chatter that you'll see, and opinions. I mean, if you go and read all of the articles on the Herald website on any one day, you'll see things about house prices are going to go up 10%, they're going to stay flat, they're going to go down 10%, they're going to shake it all about. You're just going to see all of this stuff. And then social media is that times 100. It's really easy during a boom to think, just the next crash, I'm going in there and I'm going to roll up my sleeves and buy 10 properties, and because that's what you do. Because, and I think part of this is like, you just imagine the scary things happening one at a time. You're like, okay, well, some bad things there's going to be an economic crisis and it's going to be over there, but I'm just going to go and be aggressive. But then obviously your job's uncertain, you're the one dealing with the vacancy, and your car's broken, and you've got 2 young kids, and all the news is awful. How easy is it to charge in and and do those things. It's not easy. During a crash, it's scary. So how do you do it? What did the people who during the GFC, got on with it? And I'm not talking about buying one house. I mean, the guys who went in and did 12 or 20, and systematically went about it when everything was really bad. I think what you do is you break it down. So, like the example I did earlier around rents dropping, or population changes, or values, or etc. You can generally tie everything down to a number. A classic example of tying things down to a number, it's not really tied to this crisis, is the healthy homes. When healthy homes rules came in, there was a lot of uproar around the extra costs, and I agreed there were extra costs, and I agreed that those costs were going to get passed on. But I worked out what it was going to cost me in a house to put in insulation, a heat pump, and an extractor fan, and then I tied it back to capitalizing that at 5% and then dollars per week, and it was like $2 or something like that per week. And often when you break things down to numbers, they just become things that you can put a plan around. Whereas without doing that, it's just a vague cloud of fear and doubt. One of the comments is tune into a music program and ignore the stories. Yeah, I read a few books during lockdown. Adapt to the information as it comes in, and have a plan. And I think I'm stealing another Matt Gilligan phrase of, failing to plan is planning to fail. And the folks who did that, it's almost methodical, the way the successful investors can go about working through these kind of scenes, is they put their head down, they focus on what matters, manage their risk, think a little bit optimistically, and get going. So again, it sort of looks like this, but what it is just steady, get the information, get your team, evaluate opportunities, control what you can control, and that yellow cock, implement, just do it and go again. And it's only in hindsight when people get around the bar and say, I did this during the GFC, or I did this during the COVID-19 crash, that feels like, whoa. But at the time, it was just a process. And that's what I think is counter-cyclical investing, setting your rules and sticking to it. And also not being too dogmatic. So your rules, if you think your rules need to change, then obviously look at it. But be realistic. No, the population of Auckland is not going down to zero. When you start to think about this, GFC, we had a massive brain drain. The tens of thousands of people leaving every year. Rents almost never dropped. So you kind of, very easy to accentuate the downsides. I also think, and this is sort of a difference in the modern world, is the technology factor and the connectedness and the speed of which information is passing around. There's going to be a lot of people looking for opportunities and hustling and getting out there and trying to improve their lives the minute we get to level 2 and then level 1. In the Depression, we were a nation or a world almost of farmers and factory workers. And if the factory couldn't sell the thing, we didn't get enough money, or the farm people wouldn't buy our potatoes, we didn't get enough money. The world of employment is very different now, and the way people can create value in their life is very different. And I grabbed this off the Herald website a couple of days ago, that international schools might be allowed to fly in students, put them up in a hotel for 2 weeks for a quarantine in Auckland, and then they're here for a year or two. And I've always thought that through this is that if New Zealand does eradicate or close to eradicate this virus, we might be one of the only countries in the world with high quality universities where parents, not only in Asia, but in other Western countries like America, for example, might say, look, I need to that's where I'm going to send my kid. Because if you're in New York and universities are awful and you've got this massive health crisis, and you can go to New Zealand where there's no health crisis now, virtually, or at least it seems to be managed. Why wouldn't you? And I think the frustration that personally I've had in the last, since about 2 weeks into lockdown, has been the shift to considering this an economic crisis has been very, very slow. But that is going to start now. It has to start now, as we head out of this wage subsidy thing, and as those things start to come, there's going to be a lot of pressure. A lot of businesses and industries that are affected are going to be scrambling very, very hard to try and find ways to create revenue and get going. And I don't underestimate, humans and people's capacity to get stuff done. Nobody's going to sit at home and just watch TV. Well, the people who were doing it before the crisis will keep doing it. But, anyone who's had their life disrupted, if they were a hard worker before it, they're going to be a hard worker after it. And the nature of that work is just going to shift. And so that's one of the reasons I'm very optimistic for the future. Couple of comments. And this is more for investors who are trying to time the market. I never try to time the market. Whenever I'm ready to buy, I set my criteria. I go out and try and find a property that matches my criteria or beats it, and I buy it. I don't sit there and go, oh, in 6 months I'll get a better deal. 6 months or a year, or whenever I'm ready to buy again, I set my criteria. I go out, I look for a property that matches my criteria, and I buy it. And anyone who's a professional investor or is trying to grow a portfolio, and a portfolio, by the way, is what generates our wealth. Nobody's going to retire successfully on if early financial freedom is your goal on one house. It's the portfolio effect of having multiple assets with good income and good leverage and good growth across all of that. And that systematic effective approach to just going out and building up instead of trying to just it might be cheaper in 6 months, so hold off. It to me doesn't seem to make much sense, and the reason is you never buy in the market. This is not like a share in Sony stock or Xero stock where it's whatever the thing is. You're going to buy a house, and in the hottest market you can get awesome deals. My best ever deal was one in 2 years ago in Wellington. It was a crazy red hot market, and you can get horrible deals in down markets. I bought my first or second property was an absolute lemon, and it set me back 4 or 5 years, and I bought it during the GFC when, looking back in hindsight, every investor who bought was a genius. I'm telling you, you can get it wrong. So it's more important to focus property by property and keep going. And last, again, I've never met a successful and happy growing pessimistic investor. Doesn't seem to fit. So Serena, if you're still with me, I think that's me, and I'm not sure if we've got time for Q&A.
Yes, we totally have time, and Nick, don't worry, I will always be with you. So listen, guys, we have some time for questions, but before I turn to that, I have a question for all of you. You will see on the screen, I'm asking for your investment spirit animal. I'd like to know if you are, after hearing Nick's and Chris's presentations, if you are feeling bearish, i.e. in the next few months, you're feeling like, you should go into hibernation with winter coming and not doing a heck of a lot and shut everything down and just hope that you go through the storm, or if you are feeling fairly bullish and looking forward to getting some opportunities in the market. So I have started a poll. I would like some engagement, Nick, including you as well, if you are feeling bearish or bullish.
Oh wow, there's icons.
Because I think it's good to sort of calibrate and have a sense with, just to see how everyone is feeling. So we'll keep that going. Now, I am going to look at Lincoln. I'm so pleased that you're feeling bullish. Lincoln, I sure hope I will see you tomorrow morning bright and early at the Keynote Home Development Clinic. Now, if anyone has any questions, please also use this opportunity to pop them in the chat box for Nick. I have a question, Nick. What sort of comment on the Facebook page makes you roll your eyes the most?
Well, the one that it's the one every day is I just got offered 2.99%. What's everyone else getting? That's always a laugh. What makes me roll my eyes? I see a lot of there's several things that I see all the time. One is people who would like to self-manage their properties and are asking questions where I think if you don't know the answer to that, please don't manage your own properties because you don't know anything at all. And I think if you want to...
Do you ever say that?
No, others do, and they get accused of bullying. So I just think it. But I think if you're going to manage your own properties, you're running a business. You need to understand the Residential Tenancy Act, like read the legislation. You need to understand what you will do and have procedures and policies in place for every eventuality. How you're going to document it. You need to know the tenancy tribunal process. You need to have a proper vetting process for tenants and all of that. So you basically need to do everything that a property manager does. And what most people who self-manage do is they do nothing that a property manager does, and then something goes wrong and they panic, and it's too late. So that's one that I always see. Obviously, I see people post a link from the Herald or stuff.co.nz and it's some headline that's designed to gather clicks, like blah 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 says property will go down 12% or up 18% or something, and they'll just say thoughts with a question mark. That's not really like I'd rather hear what you're thinking. That again, that's but I don't know. We see it all. One thing we did recently is we actually turned on post approval. So for years, you could just post in it, and we got a lot of. And during the elections, it was really toxic. And heading into this crisis, it started to get really toxic. We had people who were anti-investment coming in and trolling people. We had every single Herald article got shared 25 times. So we turned on approvals, and it's made it a much more pleasant place to be. And I think that the quality has gone up, and it's just generally a nicer environment.
Okay. Going forward, the next few months, I think things are still developing very quickly, and information is coming out, and people are sort of making sense of it, and the market is reacting. And I personally think networks, any form of network, whether it be the Property Investors Association or the online education network, online network like your Facebook group, can make a positive difference in investors' lives.
Yes.
So in your experience, because you sort of are exposed to both types of communities, how would you suggest to everybody listening to this webinar, how would you suggest they engage with the two different types of networks respectively?
I would like, so the interesting about social media is that, and I can see this, there's heaps of people in this group, but not everyone's active. And I'm yet to see somebody change their mind because of a well-reasoned reply, and even less so because someone ridiculed their comment. So I think if you're going to go into any space where there are other people who are at the level where you want to be, or ahead of where you want to be, or have a different period of knowledge, you should be always ready to change your opinion. And I don't know who this is attributable. There's a quote from a politician, and this is I think the right-wing crew in America do this all the time. If anyone gets up and changes their opinion, they're accused of flip-flopping on an issue, which is utter bullshit, because there was a quote which is something along the lines of, look, if the facts change, I change my belief, what would you do? And I think the best approach to anything is to show up and have the mind of a student, and actually be willing to completely consider well-reasoned advice. Now, this is Facebook, so I mean, well-reasoned advice isn't every single comment on there, but I would go in there with an open mind.
And what about engaging with PIAs?
PIA, I think, is an option. I love PIAs, and I think the fascinating thing, I've spoken at some larger groups, and obviously the national conference in Hamilton, and I've spoken to some very small ones, like I went down to Timaru, and there were people at the Timaru one who are multi-millionaire with a ton of properties and little debt and very experienced investors. And there are people who just they've been through not just one recession, like 3 or 4, and sit down and talk to different folks about their approaches, because it's just fascinating. Rotorua, we've got, I don't know if he's on there, one of the guys in the committee, he's got dreadlocks, he's young, he's, it's a cool dude, he just mountain biking all the time. He's got a dozen rentals and he just cruises around. He's in his late 20s, I think. So it's a really good opportunity just to meet people and create a rapport and throw an idea out there and say, and a smaller group, like talking to somebody one-on-one, and this is the thing that APIA I think does great. You've got all these monthly meetups and get together. You can just meet up with people and say, hey, look, I'm thinking about this, and you've got 2 people and they're almost like collaborating with you. If you put up an idea in the Facebook group, sometimes you get 400 different opinions from people saying, no, putting up rents is evil, think of the children, no, go for cash flow, add a dwelling, Rotorua is terrible, why would you go there? So you're just going to get everything. So the smaller group and the higher concentration of people who identify themselves as investors to the level they'll pay a fee to be in an association is quality.
Okay, thank you for that. Final 2 questions.
Sure.
So Adriana asks, what is a good investment strategy if you have high equity but no serviceability?
So it's very hard to buy something without being able to get lending. I think in the old days, you used to be able to co-invest with somebody where you use your equity and someone else's serviceability, and you combined to go out and do joint ventures, etc. So that might be something that you can go and have a chat with Chris about and see if there are ways that you could pair up with somebody. Obviously, it has to be somebody who knows what they're about, and you can go and do some try and get something done. So, assuming you can get some form of lending, or a lot of folks have invested through a couple of cycles now in Auckland. They've got really great equity because of growth, but the rents are not there. You might look at saying, okay, what if we took some of this capital and shifted it into a higher cash flow asset? So I was talking with a guy the other day. He bought 2 houses for $250,000. Now worth $500,000. Rents had been started at $400 a week, and they were now $500 a week. So his 8% yields were now 5% yields on value, and he wanted to retire in 10 years. And we talked about it, and I don't know what he'll do, but one of the exercises, well, look, if you took these 2 houses and sold them and built it something that's 7% yield on today's value, your cash flow, we worked it out, was going to go from 12 grand a year to 25. So imagine if you took some of that equity and just moved it into, say, a multi-income property or something that's designed for cash flow. Often I'll talk to Auckland-based investors, and they have this, why would you leave Auckland sort of thing. You can get cash flow in Auckland. It's harder. However, a dollar is a dollar, and it doesn't matter where it comes from. If you have a block of 6 flats in Hawke's Bay and it's paying you $100,000 a year from these flats, you can spend that $100,000 at your favorite cafe in Auckland. So it's part of the reason we invest in property is to create that income, to enjoy more flexibility in life. So at some point you think, why am I waiting around for this?
Okay. To Adriana and anybody who wants to sort of learn a little bit more about serviceability as well, Chris Pedersen, who had recently done us an article on the blog page on how bankers assess your serviceability. So I've posted the link in the chat box. Check that out. Question from Brent. With the trend of people now working from home, do you as an investor see any opportunities arising from that?
So it's a telecommuting revolution here. I don't know, because again, as an optimist, I'm kind of keen to get out there and get on with my life. But a lot of people are still terrified about going into work, and a lot of offices, people move around, particularly open plan, etc. So I think this new way of work is going to be in place 2 or 3 years. And how long do people have to be doing something temporary for it to become permanent? That's going to be one of the fascinating outcomes of this, because that has implications for the amount of traffic on our roads and traffic planning. And as more governments put in cycleways, etc., that's going to change things as well. So I do think that you need to live close enough to work to get into the office without it being a 4-hour drive. But perhaps in certain areas, people who are living in outer suburbs, those areas might be more desirable, might be happy to stay there. So if you're living somewhere, I'm just going to pick a place. So like, in Tauranga, let's say you're living in Rotorua and working in Tauranga, it's an hour drive. And if you only had to do that once a week or twice a week, and the rest of the time, then people will happily live in Rotorua. The cost of living is 2/3 to half of Tauranga, 2/3. In Auckland, I'd imagine be the same. So it could change demographics around the fact that people are more comfortable being away from work. I think also folks are finding video meetings are actually quite they're less productive in some ways, because you can't talk to people, just chat. But with a video meeting, you show up, you talk about the stuff, and then you're on screen, so you turn the thing off, and there's no traveling and moving, etc. So the digital meeting is a way to do stuff will change business, and I hope it catches on, because in Auckland, the last thing you want to be doing is stuck in traffic for 2 hours for a 45-minute sales meeting, if you can do it by screen. So that's going to be really interesting.
Would any of this interpretation change the way you invest in properties? Would you account for any of that going forward?
I'm going to watch it. I probably not in the next 6 months, I would say. But the shift that might happen is, in a city where new housing can go in a city is either in the center where it's dense or on the outskirts. And it's always a trade-off of distance to commute. So it'll be interesting to see if that does become more popular and people are more willing to live in remote areas and do that. But I don't think it's going to change how I invest. But it'll be certainly interesting to see where people live in high cost of living places, and I'm thinking Wellington and Auckland.
Okay.
I'm not sure. Students might be interesting, by the way, if universities move more and more stuff online and you only need to be in town twice a week. Will students want to live in the centre of expensive areas like Auckland and Wellington?
I don't know the answer to that,
No.
but
yeah, who knows? I mean, I have student rentals in Wellington. They pay $250 a week per bedroom, and that's because you're competing with people working in business at the Beehive and everything. It's just there's no housing there. And if you could live an hour out and just cruise in once a week for your lectures, then you would.
Yeah, but they definitely want to move out, right? Because that's the nature of growing up. And
yes, yeah. I mean, you don't want to be your parents in your 20s. Yeah. No.
Remember whose house you're sitting in?
So they're down here. They're looking after my son right now. They can't hear me.
Well, hey, listen. That was super fun. Thank you very much. I'm going to turn the camera on to say goodbye properly to everybody. So Calvin and Kylie, I'm sorry we don't have time to get to your questions, but Nick's email address I will post in the chat box. And it's also going to be circulated in the wrap-up email you'll get tomorrow at 7:30. So please send your questions to Nick. I'm sure he is happy to connect with you guys. And listen, thank you all for dialing in. Nick, thank you very much. And let me just check in on the polls. So I guess it's good night to the 3/4 of you who identify as bulls, and the remaining 25% who are going to be little fuzzy bears.
Yeah. I was just texting my broker before this call, so I'm going to try and get some money out of him to go buy something.
Well,
we'll see. So I'm keen.
Excellent. I'm pleased to hear that. So listen, guys, have a good evening, rest of the evening, and thanks for joining us. Tomorrow morning, we're back doing a development clinic with Keith A. Holmes, and Thursday we're doing a chitty chatty one with Debbie Roberts on what do you do if you got into property 10 years ago with hardly any regulation, thinking that, listen, I'm just going to chuck it to the side, capital gain will do its thing, and now it's 2020 and COVID, and you're like, oh my God, what just happened? Debbie is going to tell you what's going to happen from now on. So have a great night.
Thank you so much, and congratulations on 50 events during lockdown when everyone else was day drinking and trying to educate their children and stuff. It's a massive effort.
I tried day drinking on day one.
The rest of us are just trying to get through. No, but that's awesome. I mean, you have a fantastic association, and you guys do an awesome job. So, and thank you for having me on.
No, thank you very much, and we'll definitely have you on. And when this whole madness is over, we'll have you up here, and we'll have a nice little meal with a bunch of APIA members. It'll be fun.
I look forward to it.
Cool. Have a great night, everyone.
Cheers.